Alright, guys, in this video, I'm going to be going over where we are in the economy right now, what's going to happen in the future according to present economic data, where we're going, actionable insights, and what you should do with your portfolio right now. Now, why should you listen to me?
I was mentored by the Institute of Trading and Portfolio Management ex Goldman Sachs traders Anton Creel and Edward Scheck, and the portfolio manager of Dragonstone Capital, based out of Singapore, managing $3 billion. In addition to that, I have completed multiple specializations and have also created my own algorithm which is running in the markets, which has generated me over a 7,500% return over the last 15 years, all of which you can find in the bio.
Now, if you bring your attention to this chart, this is the S&P realized volatility 1 month versus 3 month. Now, this chart is closely monitored by a lot of volatility controlled funds, which really control their buying and their selling based on short term volatility versus long term volatility. If you look carefully, then you can basically see that whenever the blue line has gone above that orange line, which is basically when short term volatility has gone above the long term volatility average, that usually hasn't been pretty good for indices. Now, why is this accurate? Well, it's really because a lot of funds just buy based on market volatility. If we have the VIX or the IVX or the GBZ, which is basically a volatility for gold, volatility for the Russell, and the VIX, as you know it, the volatility for the S&P 500. When we have the short-term volatility for the S&P 500, short-term go above the long-term volatility, that usually spikes market fears. And as you can see in this chart, whenever we have a positive slope on the blue line, that has usually meant a negative return for equities. Now, this is scary accurate, and you can actually look at the chart yourself as to how it really looks. It perfectly measures that April V correction we had and the recovery after that. You can see that the blue curve completely slopes downwards, where the volatility just absolutely crashes. And now we can see again that right after November, when the market corrected, we saw the short-term volatility spike up, and now it's coming down again, which is again a very bullish sign for equities. Now it's important to look at all this information, and as you can get your attention to this table right now, what really seems to be really good investments, or what have historically been really good investments within the last month, have really been healthcare, and a trade which everyone's gone short right now is actually consumer staples. And I did a video a while back where I was talking about ETF flows, where it actually mentioned that utilities, a lot of money is actually entering utilities and healthcare at this time. And since then, it's actually outperformed the market by an absolute insane amount. So it's true, since 2010s, the ETF inflow has increased drastically, and the money managed by hedge funds has reduced a lot. So the market is completely driven by cash inflows into ETFs, and not much by institutional buying and institutional selling, but is actually more biased towards ETF inflows, as you can look at this table right now, where the AUM, assets under management by ETFs versus assets under management by hedge funds, has, well, the AUM under ETFs has actually increased by the hedge funds by an insane amount, which you can see in this picture right now, which is absolutely insane. So you can actually tell that it's all flow based. It's really nothing else. Just by looking at inflows and outflows, which you get like a report by iShares BlackRock anyways. Plus, you can look at CFTC, the Commitment of Traders report, where you can look at institutional positioning in the dollar, commodities, and other futures, other forex pairs. So these are all really important facts which people should really be looking at. And soon I'll be getting a small PDF attached in the dashboard where I basically talk about how exactly you should interpret what data and how it's actually all based on rate of change. And the numbers itself don't really mean anything.